Welcome to this workshop, Understanding Your HSA, Strategies for Health and Wealth. I am Janelle Cross. We think of your financial life as unfolding in 3 stages. The first is financial safety, where our focus is on building a good foundation. Next is wealth accumulation, where we gather resources for the final stage, financial freedom. That's when we have the money resources we need to do the things that bring the most joy and fulfillment to our lives. For more on the money stages, check out our Money Milestones course, which takes a deep dive into each stage. This is a Stage 2 Wealth Accumulation course. There are many different expenses you'll need to plan for as you head toward retirement. Among the most significant, however, are healthcare and medical costs. It's estimated you'll need nearly $300,000 just to cover these costs in your golden years. Health savings accounts, or HSAs, are like personal savings accounts, but the money is used to pay for healthcare expenses. You take a tax deduction for the dollars you contribute to your HSA. You can then use the money to pay for qualified medical expenses tax-free. While this is a new concept for some folks, these accounts have been around since 2003. But HSAs are not the only type of medical savings account. There are also health reimbursement accounts. These accounts are used by employers to reimburse qualified medical expenses paid by employees. There are also flexible spending accounts. These accounts are used to save on taxes for qualified expenses that might be medical, but might also cover qualified dependent care costs like daycare or summer camp for children. FSAs are the use it or lose it accounts, and money not spent in the year is forfeited. While this is not intended to be a comprehensive overview of these various health spending accounts, let's highlight a few key differences. First, HSAs are owned by you. HRAs and FSAs are part of an employer plan. To be eligible to open an HSA, you must have a qualifying high-deductible health plan. Only employer contributions are allowed in HRAs, but you and your employer can both contribute to HSAs and FSAs. Only HSAs can be invested. And finally, HSAs must be reported on your tax return. The real power of an HSA is in its tax benefits. HSAs are triple tax-free, an opportunity you rarely encounter. First, you take a tax deduction for the amount you contribute each year. While the dollars are in the account, your savings and investments grow tax-deferred or tax-sheltered. Finally, withdrawals taken for qualified expenses are tax-free. And if a triple tax benefit isn't enough of a benefit, HSAs can also serve a dual purpose when it comes to your retirement planning. In order to be prepared to have the money resources you need to experience a rewarding retirement, you'll need to plan for adequate retirement income. But you'll also have healthcare expenses in retirement. A good retirement plan will address both, and your HSA savings can provide for retirement income and healthcare needs. First, when it comes to healthcare expenses, whether you are still in your working years or enjoying your golden years, HSA withdrawals for qualified medical expenses are always tax-free. That means if you refrain from spending your HSA while you're working, you'll have a bucket of tax-free money to pay for doctor visits, medication, and other healthcare costs in retirement. But another important feature of HSAs is that withdrawals after age 65 are penalty-free and taxed as ordinary income. In other words, an HSA can also be a tax-deferred retirement savings account. While we don't recommend thinking of your HSA as a primary source of retirement savings, it's good to know that you can use the account for things other than medical costs. Since the main purpose of an HSA is to prepare for medical costs, it's important to know what counts as a qualified medical expense. There are, of course, the obvious things like office visits, medication, hospital costs. There are many other types of qualified expenses though too. Things like glasses and contacts, treatments like acupuncture and chiropractic care, hearing aids, and even long-term care insurance premiums subject to certain limits based on your age. Once you begin Medicare coverage, which occurs at age 65 for most people, you can use your HSA funds tax-free and penalty-free to pay for Medicare Parts A, B, D, and Medicare HMO premiums. However, premiums for Medicare supplement policies such as Medigap are not eligible expenses. Assuming you've reached age 65, however, you could take a penalty-free HSA distribution to pay for these types of premiums, but the distribution would be taxed as ordinary income. That brings us to the question of how long you can contribute to an HSA. Once you are enrolled in Medicare, you are no longer eligible to make additional contributions to your HSA account. You may continue contributing to your HSA by delaying your enrollment in Medicare coverage, but keep in mind that you are automatically enrolled in Medicare Part A when you start your Social Security benefits. Finally, you will be ineligible to make HSA contributions the first day of the month that your Medicare coverage begins. In the early stages of your financial life, you might need to use your HSA as a money in, money out type of account. By that I mean you may spend some or most of what you save during the course of the calendar year. But as your financial situation improves, you may begin to think of your HSA as a long-term investment rather than just a healthcare savings account. And like any other investment, small monthly savings contributed over long periods of time can really add up. If you have adequate emergency savings to cover medical expenses without using your HSA funds, you can think about investing to grow this account for your golden years. And like other investment accounts, you'll want to consider your situation when building your HSA investment portfolio. That means you'll need to know your appetite for risk, which we call your risk tolerance. If you haven't already taken an assessment, you can find a risk tolerance questionnaire in your MyMoneyNav portal. You'll also need to consider the likelihood that you might incur significant medical expenses in the near future, and consider your financial capacity for paying those expenses without tapping into your HSA. But perhaps most importantly, you'll need to consider your time horizon, or in other words, how long it might be before you spend the money you're setting aside in your HSA. The longer your time horizon, the more aggressively you can invest. And finally, as with all disciplined investing, it's important to be sure your HSA investment portfolio is diversified across a variety of different types of investments. As we head toward the finish line, let's cover three common questions. First, what happens to your HSA if you change jobs? The funds in your health savings account are always yours to keep, regardless of your employment status or current insurance coverage. This means that if you change jobs or health plans, you can keep your HSA and spend your funds on qualified medical expenses as usual. However, you'll need to remember that in order to make additional contributions, you'll need to have a qualifying high-deductible health insurance plan. Next, what can you do if you're not eligible for an HSA? Let's take this one in two parts. First, if you already have an HSA, but your situation changes and you are no longer able to make additional contributions, you can still use the money in the account as usual, tax-free, penalty-free for qualified medical expenses, or penalty-free but subject to income tax after you reach age 65. What if you inherit a health savings account? Like many investment and savings accounts, choosing a beneficiary is an important step. Understanding what happens to your HSA funds after you die may influence your beneficiary choices. Let's step through three common situations. First, if the beneficiary is your spouse, if the beneficiary is someone other than your spouse? And what happens if you don't name a beneficiary? When your beneficiary is a spouse, they become the HSA account owner. While you typically need a high-deductible health plan to own an HSA, spousal beneficiaries are exempt from this rule. They can enjoy the same account perks, tax-free, penalty-free withdrawals for qualified medical expenses. However, they also face the same restrictions. If your spouse is under age 65 and takes withdrawals for anything other than qualified medical expenses, they will pay a tax penalty plus ordinary income tax. The 20% tax penalty is eliminated for all non-qualified withdrawals after age 65. Finally, transferring HSA ownership to a spouse does not create a taxable event, but keep in mind the taxes and penalties that might apply in the event of non-qualified withdrawals. If the named beneficiary is a non-spouse, the HSA ceases to exist as of the date of death. The assets must be paid out to the beneficiary. The non-spousal beneficiary will be subject to ordinary income taxes. While the distribution is taxable, it is not subject to the additional 20% tax penalty for non-qualified distributions. The taxable amount may be reduced by any payments for the decedent's qualified medical expenses if paid within 1 year of death. The non-spouse beneficiary must complete Form 8889 to report the value of the HSA and the amount of any qualified medical expenses of the deceased HSA owner that were paid within 1 year of the date of death. If you do not name a beneficiary, the HSA proceeds will be paid to your estate and subject to the appropriate estate taxes. Since estates may pay taxes at a higher rate than an individual, we generally recommend that you avoid leaving your beneficiary boxes blank. Let's close with 2 case studies. First, let's consider an employee who is in the early stage of their career. They are 27 years old and earning $60,000 annually. They're in good health and covered by a high-deductible health plan. Their action plan might be to open an HSA and contribute monthly. Ideally, divide the annual deductible for your health insurance by 12 and aim to save that much each month. Inside the HSA, keep an amount equal to the annual deductible in cash or uninvested. In the event you need to make a withdrawal, it's better to take that money from cash. As you move from year to year, if you accumulate more than the annual deductible amount in your account, build an investment portfolio for the excess designed for long-term growth. Ideally, while you're contributing to your HSA, also focus on building an adequate emergency savings account and continue saving in your 401k. Now let's consider an employee who is in their later stage of career. Let's assume they're 50 years old and earning $100,000 annually. They're in good health and they're covered by a high-deductible health plan. Their action plan might be to open an HSA and contribute the maximum allowed annually. They'll aim to pay their medical expenses incurred during their working years from their bank account so that they can invest and grow their HSA for medical expenses in retirement. They may also consider using the HSA to pay for long-term care insurance premiums in retirement as well. And of course, it goes without saying that this late career employee will still want to focus on having emergency savings and making sure their retirement savings are on track. And that brings our HSA workshop to a close. Like many things money-related, this can be a confusing topic. Google is full of advice, so are family and friends, but not all advice matches your situation.